These are the top 10 investing mistakes you could be making right now. Number 1. Speculating heavily on one share. Numerous businesses have sprung out of nowhere on the stock market only to plummet back down once the initial excitement has subsided. After the 1987 meltdown, Chase Corporation's share price in the 1980s fell from $10 to $0. For many investors, the demise of Chase, which was once valued at over $3.5 billion, still causes grief. Without diversification, there is always a chance that even the best managed business could veer off course. How can you tell if a publicly traded company is poised to experience turbulence? There are a number of early signs that a business is about to fail. These consist of large-scale board and management turnover, credit extensions negotiations with banks, or ideas to raise additional funds. The offer to buy shares has not been fully accepted. Shares purchased by the board, management, and founders, delays in the approval of audit reports or the release of financial figures. My opinion. Even good businesses can fail. Going large on one firm is extremely dangerous for this reason alone, because the consequences could be wealth-destroying. Number 2. Starting a business that requires substantial upfront fees and overhead. It's fairly simple to start a business, but it can be difficult to exit it, especially if you invested a lot of money to get things going. Opening a store is a huge step that needs a lot of extra administration, so it's usually a good idea to gauge online demand for your goods or services before deciding to expand. There are numerous for-lease signs around towns and cities. Many businesses fail. Running a business is quite difficult, and it has gotten even more difficult because of border controls and lockdowns. The need of cash flow and the high cost of operations make starting a business a lifetime commitment rather than a 9-to-5 alternative. My opinion. Entrepreneurs who need to raise money or take on more debt in order to stay afloat. When customers don't purchase, costs continue to rise, and costs don't go down. Even the simplest clothing store or tortilla stand can soon run into difficulties. Family residences are at risk because banks are reluctant to lend without personal assurance. The most reliable approach to invest in your future is to start small and gain a following. For example, from a food truck to a pop-up restaurant, or from an internet store to a sample sale to a retail shop. Number 3. Being in relationship with someone who has conflicting spending habits. Relationship breakdowns are frequently attributed to money, and debts or other financial obligations may persist even after a relationship has ended. Our research team commonly hears from concerned individuals who are seeking assistance in paying off the debts from their marriage. The plain truth is that you will eventually be supporting someone else's bad spending habits if you get into a relationship with them. There will be gaps, and people will access your assets and money. My opinion. The only way to control a situation is to talk about money. Ignoring debts or the factors that lead to debt accumulation will only make things worse. And by the time things become overwhelming, such as significant debt, a lot of yelling, and general dissatisfaction, it's frequently too late. It's best to be on the same page. Number 4. Spending money on pricey ideas without first demonstrating demand. This isn't the same as opening a business. Rather, it's about suggestions for side businesses that need some startup money. This frequently involves expensive Apple goods, software, equipment, bulk stock purchases, or other outlays totaling several $1,000s. The expectation is that the investment will generate money, but there is a chance that nothing may happen and you will be left feeling very disappointed. Number 6. Considering that you can time the market when it is practically impossible. Selecting individual shares for your portfolio requires a significant amount of research if you intend to invest for the long term. You might also choose the wrong timing. Perfect market timing is very hard to attain, and investing the time required to do so would almost surely have a negative impact on your daily activities. My opinion. Well-managed funds and index funds help you diversify your risk and offer longer-term returns that are more consistent. We outline the key points in our guides to managed funds, ETFs, and index funds. Number 7. Lending funds to loved ones and pals. There is a lot of pressure and guilt involved when requested to lend someone money, and it can be challenging to discuss the situation with others. Even though it's not an investment, The money you lend has a chance of failing. If you do give someone money, it's not unusual to see them on Facebook or Instagram enjoying dinners out, drinks at the bar, concerts, seats at important sporting events, new clothes, etc. There are many emotions at play, and asking for your money back can be challenging and upsetting. Later requests for further payment are not unusual, and this might make you feel as though you are being taken advantage of. Lending money is never simple, and those who borrow frequently have a propensity to disappear from your life more and more. My opinion: since lending money is so frequently fraught with issues, it is usually advisable to refuse such requests. Number 8. Not purchasing a home even though you had the loan and deposit. Despite the issue of being outbid at an auction, life may be hard, and there are many reasons to put off or give up on home ownership. My opinion: if you have all the financing in place, there is never a bad moment to purchase a property. You'll always need a place to live, and if you can afford a mortgage, buying a home is generally a more cost-effective option than renting. Number 9. Failing to pay debt. The difficulty of paying off debts increases with age. This is due to the possibility of declining income while maintaining constant costs. Small debts can persist for a very long period if their lenders keep renewing them. The cost of living is high worldwide, and debt is pervasive. The issue is that debt is expensive, and each year, thousands of seniors who can't afford retirement take out reverse mortgages. We believe that this would be a very expensive way to spend your golden years. You can pay off debt and achieve financial independence by altering your personal beliefs and aspirations to spend less. Paying off debt is essential to having a life free of financial stress. My opinion: it may be argued that paying off debt has no drawbacks. Debt still costs money, both in the form of interest payments and repayments, even in these times of record low interest rates. If you have the resources and willpower to pay off your debt, then keeping it around is a mistake. Number 10. Being an adult without a government-backed retirement account. Without making contributions to it or receiving the government's yearly contribution in its most basic form, government-backed retirement plans are just a financial instrument to help you plan for your later years. While you forego income now, the reward will multiply over time. Despite all the advantages, though, a lot of people either never join or join but quit contributing. My opinion: government-sponsored retirement accounts are a great way to save money that, with careful planning and a commitment to regular payments, can increase retirement comfort and offer more lifestyle options. You make an investment in your future by joining. It may be argued that not joining is a bad investment. By the time you reach 65, you won't likely miss the $30 or $50 a week, but you will value having a balance of more than $200,000. Let me know what you think in the comments. Do you agree with my opinions, or do you have differing thoughts? If you found this useful, please don't forget to like and subscribe to help support the channel.